Hello, this is Chuck Carnevale, co-founder of FastGraphs. General Electric has made the news again, where it was announced that Warren Buffett, or at least some of his associates, completely liquidated their General Electric holdings and bought Synchrony Financial Corp. I found those transactions quite fascinating because they provided me an opportunity to talk about one of the most fascinating stocks that I think I've ever followed in the marketplace. Of course, I'm talking here about General Electric. And as I mentioned in the written part of the article, there's a lot of misconceptions about General Electric, how it's performed in the past. People hold a lot of opinions on the stock. What I'd like to do here is set the record straight, especially as it relates to their past CEOs, Jack Welch and Jeffrey Immelt. So let me start with a quick review of what we're looking at here. This is General Electric history since 1998. I want to point out that Jeff Immelt took over in 2000 from Jack Welch. So the earnings back here are what Jack Welch created. The earnings from 2000 up into the Great Recession, and then of course following that through 2017 are what Jeffrey Immelt is responsible for. The light shaded area are dividends paid out of earnings. The white line is a plotting of the dividends. The area below the white line are the dividends while they were still in the company or prior to being paid out. The area below is the dividend payout ratio. A couple of things here to notice. Coming into the Great Recession, General Electric's earnings fell sharply, and of course they cut their dividend from $1.24 in 2008 to 61 cents in 2009, and then again to 46 cents in 2015 before they began raising it again. And of course, Jeffrey Immelt has been heavily criticized as the CEO of General Electric. But let's take a look at what actually happened or what actually occurred with this stock. So I'm going to bring monthly closing stock prices into the equation. Jack Welch, as I mentioned, generated this level of earnings. I don't go all the way back historically. It's as far back as FastGraphs has data for it. I mean, Jack did a great job growing General Electric's earnings during his tenure, but this massive increase in stock value, which is the irrational exuberant period, of course, in the case of GE, ended in August of 2000, was really not Jack Welch's fault. This was the market driving the prices up to levels that were not justified by fundamentals. And of course, this is where Jeff Immelt actually inherited the company. He came in November of 2000. So from this point, Jeff was facing tremendous headwinds. The stock was massively overvalued. And even though he generated some pretty good earnings for a while, there was absolutely nothing that anyone could have done to keep this price from falling back to a reasonable fundamental value. Now, another thing that needs to be mentioned here as it relates to this article is that what had happened under Jack Welch's tutelage, General Electric really went from being one of the great appliance manufacturers to one of the largest capital companies in the world. And of course, that means they participated in the financial debacle that many financial services companies participated in, like Bank of America, Citigroup, etc. That's why their earnings collapsed so much, because GE Finance had become an enormous portion of General Electric's business. Now, Jeff Immelt attempted to move General Electric back into its legacy businesses, and part of that was divesting portions of GE Capital, which became Synchrony Financial, which I'll show you here in a moment. So let's just recap what it was. This was Jack Welch's responsibility, but the market rose the price to unsubstantiated levels. Jeff Immelt inherited the company, and of course, if you look at performance from his tenure, roughly, and this isn't perfectly precise, General Electric actually has a negative rate of return. But again, he was facing all these headwinds, and he was facing and inherited a company that had become a financial services company. So when you're looking at General Electric from this long-term historical perspective, I believe it's important to take into consideration how ridiculously overvalued the stock had become, how badly they fared during the Great Recession because of their exposure to the financial services industry, being forced to cut their dividends, etc. But as we come out of the Great Recession, it's moved back more into its legacy businesses as it tries to get back to its initial roots. And from this point forward, and this was still under Jeff Immelt's tutelage, they actually put together a pretty good record of both dividend increases. As you can see at the bottom here, the dividend has increased nicely over this time. They did have kind of a hiccup in earnings in 2015. However, that is what not concerns me. I do not own this stock, but I do want to make a point that it was overvalued for most of 2016, and for the better part of 2017 now the stock has dropped rather precipitously. From December of 2016, it's fallen approximately 20%, but I believe it's approaching fair value. I don't consider it fair valued yet. But let's talk about a couple of things that might have prompted Warren Buffett to go ahead and sell General Electric, because it is a dividend payer, 3.8% current yield. The company is AA rated, has 48% debt to capital, and earnings are beginning to grow again, and valuation is beginning to come into alignment. But there were a couple of things about this company that really disturbed me when I did a little deeper analysis. Let's look at General Electric from a standpoint of operating cash flows. Operating cash flows have fallen precipitously in 2015 and 2016, although they are expected to begin growing again. The same can be said about free cash flow. General Electric's earnings were still decent, but their free cash flows and operating cash flows both fell precipitously in 2015 and 16. Their free cash flow was actually negative for 2016. So from here, I'd like to go into fund graphs, what we call financial underlying numbers, and look at General Electric's gross cash flows. And you can see their cash flows have been dropping precipitously for the last several years, and actually were negative in 2016. If you look at the most recent quarters, you can see that cash flows were actually negative at times, and the cash flows had fallen off a cliff, if you will. This is obviously the last 8 or 10 quarters here, although they have recovered a little bit in the earnings report for fiscal quarter ending June 30th, 2017. And again, the same is true of free cash flow. As you can see, they actually had negative free cash flow in 2016, or in June, the quarter ending in June of 2016, but they're generating a little bit of free cash flow again. So from the standpoint of being a dividend growth investor, I'm really concerned of the fact of what's been going on with General Electric's cash flows and whether or not those cash flows are going to continue to be able to support. However, to go back to the fund graphs or financial underlying numbers here for a minute, I also want you to look at gross revenues. You can see their gross revenues have also been in a significant downtrend, recovering a little bit in 2014, 15, etc. Looking at the quarterly numbers, the revenues seem to have stabilized, but the company's revenues have clearly not been growing. So I don't see General Electric as a great cover of their current dividend based on what's been going on with revenues and cash flows, although the company is forecasting that that's going to improve going forward. So to kind of summarize and finish up on General Electric, there were a lot of reasons why this company was a poor performer. Massive overvaluation, significant participation in the toxic financial markets that we had coming into the Great Recession, moving back to their roots. In 2013, they spun off the Synchrony Financial, which I'd like to take a look at that right now. I'm not sure General Electric still cuts the mustard as a dividend growth stock at this point, but it does look better than it has recently, with showing signs of improvement. But here's the Synchrony Financial that Warren Buffett bought. And of course, it was spun off in August of 2014. Kind of flat earnings for a while. The company started paying their first dividend in 2016. And what's interesting is their earnings are forecast to grow by 24% for fiscal year 2018 and 2019, although they are expected to be negative this fiscal year. But if we're looking at forward, analysts do expect this company to average double-digit earnings growth going forward. And if you put it into the normal PE ratio, I want you to notice when you looked at this historical graph that the market has significantly valued this stock at about a 12 PE, 11.9 is the actual calculation there. So if we use that 11 or 12 PE ratio, and I'll go ahead and put on the 12.4 is all I have. I'm sorry, there's a short history here. If we apply that PE ratio, you can see that those earnings estimates are liable to create some pretty strong future returns, and you can maybe see why Warren Buffett, or at least his minions, were interested in investing in Synchrony over General Electric. I hope you've enjoyed this video. I find the General Electric story fascinating. There's a lot of reasons why a lot of the things happened with that company. And I hope this gave you some additional insights into what General Electric has looked like, where it is now, and where it might be going in the future. Also, I hope it provided some insights into why Synchrony Financial might be an attractive dividend growth stock with a focus on total return going forward and a 2% dividend kicker. This has been Chuck Carnevale saying thanks for watching. I hope you found this of value.